One thing that we haven't really brought up is the effect of the direct stimulus to illegal or migrants, I guess, refugees, let's call them, because they come and they get a monthly stipend, they get so much per person, per family. They get credit cards, set up with housing. Like, how does that, where does that factor into both the U.S. and Canada? Because they both have the same problem. You get migrants coming in, they're flown in from wherever, and they get direct stimulus from the Canadian government or the U.S. government.
It's not a lot in the scheme of things. Like it's not enough to really move. You can see it right here. It's like they've been handing out that stimulus, but it's not really moving the needle on the M2 money supply, right? And so, as questionable as what it is in terms of like the benefit of society, it's like when you actually just step back and look at the aggregates, it's like it gets a lot of attention, but it's not going to move the needle on this, right? I mean, arguably, yeah, the money should be spent somewhere else, spend it on people who are living their lives legally, right? I totally get that argument, but is it likely to move the needle on the M2 money supply? I don't think so. It would be more, naturalized Americans, a group of naturalized Americans, and they start, forgiving every student loan under the sun, or if your skin color is one way, they're going to give you a whole bunch of money. It'd be like you'd have to give it to tens of millions of people, not millions of people, like the migrants, right? And so, yeah, are they giving millions of people money? Yes. Are they giving tens of millions of people? Not yet. You know what I mean? Like, it would have to be that sort of, although it sounds like a lot, it's like millions of people. It's like, the U.S. has 340 million people. So if you give a bunch of money to 2 or 3 million illegal immigrants, it's highly strange when you hear it, but when you really step back and look at the math on how much you're injecting in there, it's not that much, right? As opposed to, how much would be injected if the central bank starts, just going in and buying a couple of $1 billion of mortgage-backed securities every single month. Like, it's just like it's one is massively different on the orders of magnitude different on the effect, right? So, that's a really good example, because it's one where people will focus on, but they don't step back to actually calculate the math. It's like, okay, if there's 2 million illegal immigrants and they give them all $3,000 a month, it's like, man, I'm really pissed off that they did it. I could have used that money, but it's not going to move this. It's just not big enough to move that. It's like spitting, it's like kind of like spitting in the ocean, right? Even, they turn around and give, $100 million to the Ukraine tomorrow. This number is 21 trillion. You know what I mean? So 100 million is a rounding error in this number, right? As strange as that sounds, it's like they have to do, it's what they're actually going to do to increase the money supply. So the things that you're looking for are mass direct stimulus, not to millions of people, to tens of millions of people, or 100 million or more. So mass direct stimulus, right? And so you have to separate out that, because a lot of things that get the headlines and the controversy are to millions of people, and they're not big enough to move this needle. And then the other one, would be, is the central bank just going to expand their balance sheet? Are the treasury auctions going poorly? So in other words, those rates start creeping up. It's like the central bank just really controls the short-term interest rates. The market controls the long-term interest rates, supposedly, unless the central bank starts buying those bonds, in which case they control both, right? But so far, they're not really expanding their balance sheet. But if they actually do start expanding their balance sheet, which I think is inevitable, because you just talk about the U.S. spending the U.S. spending $1 trillion. It's hard to even contemplate, right? Like, it's hard to even wrap your mind around it, the $1 trillion in interest per year. But if they just roll over their existing debt at 5%, it's like they're going to $2 trillion in a hurry. So they can't afford it. They're going to have to control those long-term interest rates, and they're going to have to start buying. They're going to have to basically start monetizing the debt and putting it on the central bank's balance sheet. That is coming. It's inevitable, right? But the question is when, and how much influence that they have on it. And either of them could come in and replace Jerome Powell. They could, put their own person in though, or exert a whole bunch of pressure on them to make sure that they do start expanding the balance sheet, right? So those are the types of policies. The other one would be some sort of change in lending restrictions. And so, ways for U.S. citizens to get mortgages. Can they get more mortgages? Can they get more money to buy businesses? So that's where most of the money creation occurs, is at the commercial bank level, right? But the commercial banks are kind of bound by restrictions on how much they can actually, how far up they can leverage their balance sheet, right? Mm-hmm. And so if they start reducing those lending restrictions, both of those are hundreds of billions of dollars, right? They have the delayed effect, but that's kind of what you're looking for. So it's like A, who gets elected, and B, separating the controversial announcements from the announcements that are going to really affect the money supply. And I don't mean by affect the money supply by tens of millions. I mean what's going to affect the money supply by trillions, right? So, you need to start this thing creeping up from 21 or 22 to 23, 24, 25. It's like, what's actually going to increase the money supply? So always step back from that announcement, and that's what's going to tell you where this thing is going, right?
And circling back, how does that affect us here in Canada? And in what time frame?
Yeah, the longer the U.S. keeps their money supply tight, the worse the Canadian economy is going to be. In an absence of direct stimulus, there's really no, and I mean mass direct stimulus to tens of millions of people, which I'm not sure is going to happen. I think there's going to be some form of, even if Harris wins, I've heard some direct stimulus, but it seems very highly targeted, and maybe a little bit morally reprehensible on what they're planning, but at the same time, it's like it's not going to move this, right? I haven't heard any plans for direct stimulus that would affect tens of millions of people yet, right? So in absence of that, it's like, how quickly does the central bank step on the money printer, and how quickly do they change lending restrictions? Like you saw, a glimpse of that in Canada. It's like, all of a sudden 30 years is now the norm for mortgages. Like for all intents and purposes, 30 years is the number now, right? There's very few circumstances, starting in the new year, where you wouldn't be able to get a 30-year mortgage, right? Unless it's like, an existing homeowner. They can no longer go. They can't go 30 years on the second home that they bought on a high ratio mortgage. Mm-hmm. But if they put their 25% down, if they put their 20% down, they could still go 30 years. So let's say 80% of the mortgages in Canada are eligible for 30 years, right? Like that's going to be a big deal, right? As well as you've seen, the ability to create suites, like that sort of thing is coming into effect. So you'd have to see something like that on a mass scale in the U.S. Is it significantly easier for U.S. homeowners or prospective homeowners to get mortgages? Is it significantly easier for business owners to get loans? Those sort of things increasing the money supply are the lending restrictions that the commercial banks loosen, so they can just basically just lever up their balance sheet further with existing lending, with existing individual lending restrictions. So those are the challenges you're looking at the time period of when that person gets elected, when they implement that decision, how long it takes for that to increase the money supply, and then you still have a 2-year wait. You still have a 2-year wait, right?
Yeah, so they're halfway through their term, and whatever's been going on. So you're not going to see the good things or bad things that happen for a couple of years, and then from there, it's like you got to make a decision where to go after that. So really, their election cycle starts 2 years before the actual election.
That's right.
All the rhetoric and
unless outside of direct stimulus.
Yeah.
If they come in and make their changes on day one, you probably don't start to feel the effects of their changes until 2 years. So it's a pretty long time horizon, but people kind of have to understand that. I think the inevitable pivot by the central bank is kind of baked in. It doesn't matter who gets elected. That's the end game. It's like that's what we always bet on here is asset inflation, because they can't afford their debt. They got to print new money just to pay the interest on the debt, and that inflates the value of all desirable assets eventually. So